Should you open the credit card and get the discount, or will it totally kill your credit score? What about having your credit pulled when shopping lenders for a mortgage? Will your score drop so much that it will affect you even getting the loan? If you have questions like those, you're in the right place. Today, I'm going to debunk the top 10 lies about credit that are holding you back from getting a great mortgage. But before we do, let me introduce myself. My name is Linda Shinpaw. I'm a licensed loan originator powered by Edge Home Finance Corporation, and we are the #1 national mortgage brokerage in the US. Let's jump right in. Lie number 1, you need to carry a balance. The truth is, you can build credit by using your credit cards and paying them off in full. All right. You do not need to carry a balance and you do not need to incur interest. Here's how I have done this and how some of my clients have done this, and it's a great strategy. Take one bill that you have every month, like a cell phone bill or maybe a gym membership, and just let it auto charge to your credit card and pay it off every month. You could also maybe just use it for gas in your car, but just pick one small thing, charge that every month and pay it off. You do not need to carry a balance and you do not need to incur interest. Lie 2, checking your credit lowers it. That is not true either. In fact, the truth is we can do what's called a soft pull and it'll have 0 impact on your credit score. There is something called a hard pull and it does have a little bit of impact, but it's so minimal. Let me explain. This is the area I deal with the most. Being a mortgage broker, one of the biggest tools I have when I'm helping you get pre-approved for a loan is to pull your credit report. I need to see the score. I need to see the history. I need to see the amount of debt that you have. It is critical in what we do for you. So in the beginning though, if we need to, we can just do a soft pull. A soft pull is kind of an FYI pull, right? For your information only. It allows me to see your scores. It allows me to see the debt and the history and everything on the credit report, but I just can't officially attach that to my mortgage file for approval. So it's just a wonderful roadmap of like, this is what's going on here for, Mr. or Mrs. Homebuyer. Now, the hard pull actually tells creditors and the credit bureaus that you are trying to sign up for new credit. Okay, so it does have an impact. It can affect your credit score 5 to 10 points, not a lot, and it doesn't affect it for very long. So don't freak out about that, okay? I promise you, don't freak out. The other thing you need to know is that when you are shopping for a car loan or a home loan or anything like that, I like the car example because that's really easy. So let's say that you've gone to Toyota and Lexus and maybe 2 other places, and you're looking at different kinds of vehicles, and you've fallen in love with 2 or 3, and you've actually asked them for financing options. You're having your credit pulled by different companies, right? But it's for the same reason, the purpose of buying a car. And so you're protected depending on which credit bureau and agency we're talking about. You have between a 14 and a 45-day window to have your credit pulled for the same reason, and it only count as one pull. So that's pretty cool. There are some things there. So checking your credit doesn't always lower it. And when it does, it's minimal and you can shop around a little bit inside that window. Okay, lie 3. Closing old cards improves your score. Listen, I am an organization freak. I love to tidy things up, throw out the old, in with the new, and have, the least amount of manage possible. So, going through your credit report and closing out cards that you don't use seems like it would fit right in line with getting things in order. However, here's the truth. When you close an account, it actually shortens your credit history, and it can also reduce the total amount of available credit on your credit report to you, both of which could lower your score. What does that even mean? Okay, so the credit agencies like to see credit open for a long period of time, and they like you to have a really good credit history over a long period of time. So let's go back to the first thing we talked about. If you have a card that you have had forever, use it for one little thing every month or every couple months and just keep some good history going there. It'll give you lots and lots of positive points. Also, if you're not putting much on that card, then you're the proportion that you're using is really small, and the credit bureaus love that. And so they love that per card, and they love that for like your total credit profile too. So keep that card, use it a little bit, and it actually will help you. Lie 4. You need a high income for good credit. Guys, income isn't factored at all into your credit. In fact, I was kind of surprised to hear this lie because I don't get asked it a lot, but it is a concern. I was really surprised as I was doing my research. So, credit scores are all about responsible credit use. It has nothing to do with how much money you make. All right, number 5, you only have one credit score. Not true at all. In fact, there are multiple scores depending on the credit bureau and the model. And for mortgages, we pull 3. So I use TransUnion, Equifax, and Experian in the mortgage world, and we use the middle of the 3 scores in order to price out your interest rate and terms. How you doing? All right, is this making sense? If you have a lot more questions than I'm answering right now, I want you to know that I have a couple ways that you can reach out to me. You can set up some time on my calendar in the link in the description here, so please do that. You can also request my free Smart Homebuyers guide, and it is a great resource I've put together, and it'll explain the home buying process from tip to tip. So please reach out to me personally, grab my free resource. Let's stay in touch because I don't want you to feel frustrated or concerned or have questions that go unanswered. Put them in the comments below, whatever you need to do. Just please reach out. Don't feel stuck. Let's jump back into these lies. Okay, lie 6. A good credit score guarantees loan approval. It doesn't. It doesn't. Listen, a good credit score really helps you get loan approval, but it doesn't guarantee it. There are so many more factors that we have to talk about. Lenders also are looking at your income, at your debt to income ratio, and many other factors. Okay, so income. Kind of obvious, you've got to make enough money for it to make sense for you to not only pay the debt that you already have, but cover the new mortgage loan that you're trying to get. DTI, debt to income ratio. With this calculation, we make sure that you have a reasonable debt load compared to your income. And we also are including the new loan that you want to qualify for in that calculation. And finally, there are some other factors that could impact you getting approval. You may not know this, but let's say you pay alimony or child support and you're behind with the court orders. That's going to be a problem. You've got to get current on most of our loan programs in order to get approval. So there's lots of things that impact your loan approval, not just a great credit score. Lie number 7, bad credit lasts forever. It doesn't, right? That is great news. The truth is that most of the negative history on your credit report will fall off after 7 years. And during that time, you can rebuild your score and you can still get a loan, even though there's some negative credit items on your report. So let me tell you, if any of you have had to go through bankruptcy, that will hang out for 10 years. That is an exception here. And it's a line item on the credit report, and you'll have to probably explain that for 10 years, but it won't prevent you from getting financed. And I also want you to know that there are loan products out there that can help you like day 1 after a negative credit event. So late payment, foreclosure, collections, even the bankruptcy guys. If you have additional money to put down and if you're willing to use some non-traditional loan products, they are available. So just as a side note, I don't want you to feel hopeless if you've had some significant negative credit issues. They are all overcomable. In general, after about 3 years, FHA, VA, and conventional loan guidelines allow you to get an approval with some of these negative credit events. They might require a letter of explanation or some other compensating factors, but it's doable. We do it all the time. So bad credit doesn't last forever. You just have to work through it. I've had people that had major medical issues, right? One of my friends was in a horrible car accident. And after that, he couldn't work for quite some time. And all of his bills piled up. And a couple years later, he was his only solution was to file bankruptcy. He just had to, in order to wipe all of that clean and get that behind him and move forward. And so during that time, we had a plan for him. And after that time, we had a plan as well. And today he owns a business. He has a great house. Life is back to normal like before his accident. So guys, real things happen. And if you're in the middle of any of that, please reach out and I'm more than happy to help you. I've been doing this for 23 years. And if I haven't personally experienced it, I've had a friend or a client experience it, and I will hold your hand and we will come up with a plan for you. There is hope. This doesn't last forever. You will get through it. So please know that. Number 8, paying collections fixes your credit instantly. Nope, it doesn't. However, it will boost your score, and it is something you need to do for the long term. I answered this question a lot, and I'm really happy to talk about it here. So whenever somebody comes to me and they have some collections, maybe you moved across country and you didn't know that you had a final power bill, right? That happens all the time. There are utility collections on people's credit reports that they had no idea even existed, again, from a move. You might have some silly medical bill of $60 that you had no idea. You did the copay, your insurance took care of the rest. You had no idea there was this ridiculously small balance haunting you on your credit report now. And there's all kinds of other scenarios, but these are things I see commonly. Here's the deal. Any activity in the collection section of your credit report is going to pull your credit score down, okay? Activity in the collection section will pull your score down. So whether it is the collection reporting every month that it is active and you need to pay it, or whether it is that glorious moment where you pay it off and it's behind you now, all of that is activity in the collection section. However, once you pay it off, guess what? No more activity in that section. So the month that you pay it off, your credit score is still going to suffer because of the collection. But after that, when there is no more activity going on in the collection section of your credit report, your score will climb up and up and up, okay? So that's how it works. Simple, but that's the process. Number 9, using credit cards is bad. Everybody has heard of Dave Ramsey, right? Like him or love him, what a beautiful thing, right? To pay cash, to have no credit cards, not have to be worrying about debt and payments and getting late and all of those things. Unfortunately, in the mortgage world and for credit scoring purposes, credit cards are a tool. They're a tool in your toolbox. And if you will use them responsibly and pay them on time and keep the balance low, you will have a very high credit score. And when you need to go borrow money, it's going to be a much more pleasurable experience. 35% of your credit score is on your payment history. And so using credit cards regularly, having something automatically hit it every month so you can pay it off on time, showing the credit bureaus that you know how to borrow and pay on time every time, it's just going to keep your credit score in a really great place. So like it or not, credit cards are a tool in the tool belt in order to have a great credit score and in order to have a much better experience when you go to get loans in the future. All right, and lie number 10. Again, this is one I don't get asked a lot. And this was another one that kind of surprised me doing my research. But sometimes people think that married couples share a credit score. Like what my husband's score is my score and mine is his. And we're completely stuck, right? It's not true. Everyone has their own credit score. Now, if you have some joint credit accounts, like if you're both on the car together, if you're both on a mortgage together, even if you're both on a credit card, that activity will impact both of your scores, but you will still have separate scores. So in my world, my husband and I aren't always on every loan that we take out together. We have a lot of things that we're on together. So, maybe we have a couple credit cards that we have a joint account with. And when we buy a house, a lot of times we do buy that together. So that's going to impact both of us. But I might have a car loan in my name only. And so that's only going to impact me. It's not going to affect his credit score. Maybe you have an RV loan or a motorcycle loan or a boat loan, something like that. And it's only in one person's name. So that's only going to impact the one person. And this is actually really favorable too, because sometimes one of you in the marriage has had a negative credit event in the past. Maybe like my friend, maybe something really bad happened to you and you have a bunch of collections, or you had to have a foreclosure, or you filed bankruptcy. And so because that's not automatically affecting the other spouse just because you're married, it allows you to have a normal credit profile in order to buy things with, as the other person is working through their negative credit experience. So, anyhow, that is really important for you to know. I hope you found this video helpful. It's so important to know the truth and how credit impacts you. Because not only, I'm speaking mostly from a mortgage standpoint because that's what I deal with every day, but a high score just makes life so much easier with whatever type of credit you're trying to open. Comment below, let me know which one of these resonated the most with you, and maybe you've heard another lie. Is there another lie that you've heard that you're like, Linda, what about this? I love it when people give me those scenarios, because even though I've been doing this a long time, I always hear new things, and that's what keeps it fun. That's why I'm still doing this. But be sure to subscribe so you're the first to know when any of my videos come out. If there's something you'd like to hear me talk about, let me know that too. And it's important to me that you know the truth about the mortgage process and all of the things concerning it. If you need more information, click on my links, get some time with me, grab my Smart Home Buyers Guide, and I'll see you on the next video.